This Wednesday brings the latest US inflation report. And within this video, I'm going to outline exactly why it's important, what we're expecting from the numbers, what could actually happen, what the underlying trends are in terms of inflation, and whether this is going to adversely or positively impact the likes of gold and US equities. So first, let's kick off with what the markets are expecting. And this is the outlook according to Trading Economics. The core and headline numbers on a monthly basis coming in at 0.3 and 0.2. That's what markets are expecting. Now, bear in mind, to get down to target, we need to see something roughly around 0.2% because, of course, 12 months in a year. So it'll take us over 2%, but it's in that ballpark, around about 0.1 to 0.2. So, of course, that core reading, if it comes in at 0.3, is hotter than they would like. And we can see in terms of the year-on-year metrics, they are expected to rise 2.9 from 2.8, 2.5 from 2.3. So set within this wider backdrop, we're seeing the potential for people to think that it may take longer for the Federal Reserve to start cutting interest rates again, or the pace of interest rate cuts will be slower once they actually do kick back in at the second half of the year. That's what markets are likely to perceive if we see hot inflation data coming out. And as you can see here, markets, by their nature, even if they're coming as expected, are expecting to see this coming in higher on the year-on-year figures. So 2.3 up to 2.5, 2.8 up to 2.9. So there could be stories around the sort of reflation move given the Trump tariff moves that we've been seeing. And remember, this is data from May, so this is kind of in the midst of everything that's happened since Trump's come back into power. But the trend has been downwards, and you can see that the sort of main three, it's the core PCE, which is the Fed's favored metric, alongside the CPI and the core CPI. And all of them have been on a downward trajectory. We're yet to really see a notable uptick in terms of these figures thus far. And you could say that this report provides exactly that, because as we saw with the previous slide, we're expecting to see a potential rise across both headline and core CPI figures. But is that something to be worried about? Well, we do have a number of indications that potentially we are going to see a resurgence in terms of inflation. It doesn't necessarily mean that that's going to happen, but it's something that has been driving market expectations of late. So as we can see here, I've got a number of manufacturing surveys in particular. Of course, the tariffs are particularly pertinent for the manufacturing sector. And you can see here, when we're looking at the breakdown in terms of the likes of the Philly Fed, the Empire State, the ISM, and the Richmond Fed prices paid metrics, you can see by and large pretty much all of them have rebounded. The only two lines on this chart that haven't rebounded are the two core inflation metrics, the core CPI, the core PCE, both of them remaining on that downward trajectory. So you might think, well, you know, maybe that's just sentiment. But by and large, a lot of these surveys are actually people on the ground that are sort of talking about the experiences that they've had. Maybe it's a case that this hasn't actually kicked in yet. So maybe the reflation move might be down the line. And we'll come on to that. Because essentially what we can see here, and this is me coming onto it. So yeah, what we can see here is if you add a 6-month lag onto the rebound for or the trajectory of movements within the likes of the ISM PMI figures on the prices paid metrics, you can see a much closer correlation. So if you see the peaks, it's sort of in the middle of this chart, 21, 22, much more closely aligned when you provide a lag. So we've got both manufacturing and services PMI figures from the ISM, with the prices elements have surged of late, as you can see on the right-hand side of this chart with the two blue lines. That surge has not provided a surge in terms of inflation. And what I've done here is shown you inflation in three different ways when it comes to CPI. So the year-on-year metric, which is what most people are looking at first and foremost, but then the 6-month annualized and the 3-month annualized. The 3-month annualized, which is your red line, essentially is telling us over the near term, the past 3 months, what trajectory is that on? So ultimately, you know, we need to see an uptick in, most likely we would see an uptick in terms of that red line before the others. if we do see an uptick in terms of short-term inflation pressures. But as we can see here, it might take a bit of time to actually work through. So the reflation move might still play out, but generally you'll see a sort of 6-month lag, which means that maybe in a few months' time, we see this really sort of providing a significant resurgence in terms of inflation in the US. Remains to be seen, because ultimately the prices paid element might drop off as well. You know, it's quite fluid in terms of the relationships that are happening in terms of trade, given the ongoing discussions between Donald Trump and the likes of the EU, likes of Canada, the likes of China, many of their major trade partners. You know, they could still strike a trade deal, which could bring down those prices paid elements. But as things stand, this does point towards us potentially starting within the next month or so to see inflation really rearing its head once again. And you can see markets have been expecting it. You can see the 1-year and the 5-year inflation expectations, according to the University of Michigan Consumer Sentiment Survey, have pointed towards a potential sharp rise in terms of inflation. Now, this is consumer sentiment, and you might say sentiment is all well and good, but doesn't actually make people charge more. Well, you know, it can do. It can do. Because when you've got sentiment of higher prices down the line, sometimes you'll see people actually bring forward their purchases in anticipation of higher prices down the line. So suddenly you've got higher demand over the near term. People think they can charge more. The businesses also start to see the potential for higher prices. And so they adjust their prices according to demand and their inflation expectations as well. So it can kind of feed into each other. And we can see exactly that here. In terms of how inflation has been going, like I said, with that sort of 12-month, 6-month, 3-month breakdown, we haven't necessarily seen a resurgence yet. And you can see here in terms of, I've sort of split it up in a number of different ways. You can see here, according to the 6-month sort of figure, I wanted to use something that's kind of in the middle. You know, we have seen it turning around across all metrics here, turning towards the downside. So we're yet to see a sort of major resurgence in terms of price pressures. And you can see that here. So I've got headline CPI in green, core CPI in blue. The downward trajectory very clear over the years, as we see in the top, which is the year on year. The middle is your month on month, and you can see the March figures very low. We've come back towards that 0.2 region over the month of April, but by and large, the last few months we've been kind of where we need to be. And in actual fact, it was January, December, November, you know, those kind of months that were really troublesome. But things have kind of been brought under control of late. If you look at the 10-month annualized, it does highlight the potential for near-term gains, though, right? So core CPI is at 2.8. That's expected to rise to 3.1, essentially, in the next 2 months. And the CPI figure is at 2.3. That's expected to rise to 2.7, 2.8. And when I say expected to rise, if you annualize out the 10 months of the last 12, and say, if we have the next 2 months on the same trajectory as the average of the 10 months we've just seen, where would we be? And the reason why I'm doing that is because if you look at the month-on-month metrics in the middle on the left-hand side, the May and the June figures are relatively low. You can see 0% for the headline CPI on both May and June. So when that drops out, it provides the basis for base effects to kick in. Base effects meaning if you've got a very low figure in the past that's dropping out, so the May of 2024 is dropping out, if it's really low from last year, there's a strong chance that even if we see a normal enough number like 0.2, inflation on the year-on-year figure is going to rise. Conversely, if we see a very high monthly figure from last year dropping out, it's a good chance that it means that inflation is going to drop on the year-on-year metric because it's been stripped out of the 12-month calculation. So from a base effect standpoint, we're likely to see increased inflation over this month's reading and next month's reading, even if we see inflation largely under control around the 0.2 mark, which is what markets are expecting. So we could, over the course of this report and the next report, see inflation moving upwards somewhat to the point where maybe core goes from 2.8 up to 3.1, and headline goes from 2.3 to 2.7, 2.8. But that's when we start getting back into a position where we see inflation flatlining, starting to roll over once again. So good chance inflation is going to be in the sort of mid-twos for a little bit of time. Quite frankly, the remainder of the year wouldn't be surprising. The caveat here, of course, is that at some point, there's a possibility that we see inflation kicking in once again. Remember what we're talking about in terms of the ISM prices paid elements when you provide the 6-month lag, does point towards a possibility that inflation really rears its head once again. So that's going to be particularly interesting this time around. The fact that inflation is expected to rise shouldn't really be the thing that provides you with a concern that, something's changed. That's not the case unless we see the monthly figures coming in elevated. If the monthly figures come on track and the yearly numbers are on the rise, I wouldn't necessarily worry about it all too much. But inflation over the coming months will be absolutely key because, as we've seen, there's a possibility that we start to see reflation coming into play if we don't see these trade deals agreed. One deflationary effect has been the price of WTI, or crude as a whole. You can see here, if I overlay the month-on-month inflation metrics with the trajectory of WTI, but I provide it with a 1-month lead, you can see that there's a relatively close correlation. There's essentially headline inflation, if we've been seeing significant downside in terms of oil prices prior to that, can be sort of dragged lower because of that energy effect. So you can see that by and large, we've seen inflation sort of consolidating a little bit, sort of regaining a little bit of ground since then. So wouldn't necessarily say that this points towards a dramatic deterioration in terms of inflation just on the energy front, but prices still remaining relatively low when it comes to energy. Now let's get on to how the markets are going to react. So the green line here is the expectation for where interest rates will be under the Federal Reserve by year end. And so the higher the green line goes, the less rate cuts markets think are going to happen. Now, if we look at the relationships that we've been seeing here, we've got the Dow Jones Industrial Average in the red line, and that's been tracking it very well. What does this mean? What this means is that markets essentially don't care too much about the amount of easing from the Federal Reserve. They just care about whether the US is in a recession or not. And so if we see data moving towards the upside in terms of stronger economic data out of the US, then it makes people feel good about the direction of travel for the economy, but they realize that that comes with the caveat of maybe we're not going to see many rate cuts from the Federal Reserve this year. But the key thing here is that we don't see a collapse in the US economy. So the caveat to that is, look, when we're talking about good and bad data, inflation is a little bit of a difficult one, because if inflation's at zero, then an increase in inflation will be deemed good news. If inflation is at 10%, then an increase in inflation is not good news. So good and bad data kind of not as relevant when it comes to inflation. Then when we're talking about the sort of outlook on what it says for the economy, you could take it from that perspective. But I don't necessarily think that people will think, oh, because we see a hot inflation metric, that means that the US economy is running hot at the moment and it's looking strong. You could say that for the Chinese. The Chinese have just come in with CPI of 0.1%. That does highlight that the Chinese consumer and demand within the country is somewhat weak, but we wouldn't necessarily say that on this occasion. So therefore, I think that inflation on this occasion, if it comes in hot, will be perceived as concerning because it essentially ties the hands of the Federal Reserve. And so you would likely see, if you see hot inflation data coming out, you'd likely see that green line rise, but likely the red line move towards the downside. So that would see a potential decoupling of these two lines if we see hot inflation data. If we see inflation coming out towards the downside, so weak inflation data, then we're likely to see upside in terms of equity markets, so optimism about easing coming into play, but downside in terms of the rate expectation, so the additional rate cuts being priced in. So let's just take that, and then we can go on to gold after that. So let's just jump onto the chart for the Dow Jones Industrial Average and see exactly how things are shaping up. So let's just work our way in. So long term, this is your chart, right? Long term, very clearly a bullish trend in play. What's happened since then? Well, of course, we've been creating these higher lows. So here's your notable swing lows on the way up, and we appear to have just created a new one. Whether or not this hits doesn't really make that much difference because we are where we are right now, right? We've sort of posted this really strong pullback and rally with that long lower wick at the 61.8, and we're moving higher since then. The question mark here is, look, we've regained so much ground and we now only have all of a sum total of 5.5% up to the highs. So still a decent amount, but we have regained a significant amount of ground. We've come into this resistance level that's here, 42821. And so it's just like, is it justified for us to continue to run higher without the data or a trade negotiation breakthrough? And so that's why if we see weak inflation data, it points towards a possibility of further Fed easing, and that could provide the basis for that breakthrough 42821 and a continuation of this rally. Now, ultimately, if we're looking at the sort of short term, you can see on the hourly time frame, and we start marking up the sort of swing lows, we can see that, you know, as things stand, we have got a nice sort of uptrend playing out anyway over the course of the past week. So that means if we break through the 42211, then it starts looking like we're going to roll over again, particularly if we don't break through resistance of 42821. But if we continue this trend, then it points towards a potential break through that resistance and a continuation of the rebound that's been playing out since those April lows. So as it stands, the trend is still bullish, and it would take a breakdown on the intraday basis to signal an end of that. Like I said, when it comes to the inflation data, it's a question of, you know, do we see something very concerning that's going to derail this? Something concerning would be a sharp uptick in terms of inflation. And we haven't seen it quite yet. Markets are not expecting that either. So then we can talk about gold. So gold, I've inverted on this chart. So essentially, as we have seen expectations of lots of rate cuts, so the green line declining basically, as we see markets expecting the Federal Reserve to ease a lot, so gold was rising constantly essentially. And at the turning point where we saw markets suddenly start to say, actually, we don't think we're going to see much from the Federal Reserve, and we see those rate expectations, year-end rate expectations rise, that's where we saw gold essentially go into consolidation mode. So what does this tell us? It tells us that when markets are feeling optimistic about the Federal Reserve's easing, gold outperforms. But when that reverses, gold consolidates. It doesn't necessarily pull back in a meaningful manner. That to me highlights innate strength for gold. It points towards the possibility of another pop higher, particularly if we see expectations of the Federal Reserve to ease growing. So from the perspective of this report, it means that coming off the back of Friday's jobs report, which came in relatively strong, where's the pressure for the Fed to ease, right? Is it going to come from inflation being very low? And in which case, this Donald Trump saying, you know, Jay Powell, you know, he's always too late. Maybe he thinks, well, maybe I am being too late because inflation's not popped yet. The caveat to this is, as we've seen in the previous charts, there's this lag that could potentially start to kick in. But certainly if inflation rises more than expected, you would see that green line rise, and by and large gold probably weakening a bit, remaining within this sort of choppy period. If we see inflation coming in low, that disinflation could provide that next spark for gold. So let's just wrap it up by looking at the chart for gold. Here we go. So from a long-term trend, it's a great one. And ultimately, the periods where we've seen the Federal Reserve pivot into a phase where they ease significantly, that's where we've often seen it doing its best stuff. So let's look at the Fed funds rate. And we can put it in a new pane. So let's see. So we've got upside in terms of rates, not great for gold. That pivot point, that turning moment back in 2000, it essentially kick-started a bull run that lasted from 2001, essentially, all the way to the peak that we've seen here to 2011. Now, in the middle of that, we saw rates rise and then fall once again. So that next one had essentially, you can see where we sort of flatlined at the top here. That was sort of consolidating. The moment we started cutting rates once again, so 2007, 2008 crisis, that's when gold kicked on once again. And then that ran from that first cut from 2007 to 2011. So let's look over here. We can see that by and large gold, after this period, we saw the rate cuts, we saw the protracted bull run, and then we just moved into this sideways holding pattern. When did we see price start to kick upwards once again? Well, you can see at this turning point here is the point where we broke out of that basing pattern and we started to run higher once again, hit a record high soon enough after that easing process. And then we consolidated, and that consolidation phase lasted throughout the period where we saw interest rates hike. We didn't see major pullbacks within that. And then what happens? We see gold start to run higher once again. Why was gold running higher despite the fact that we saw flatlining rates? Well, and I was talking about this back here. Ultimately, where rates were going up, it was very clear that rates were going to have to come down because they weren't going to keep them up here. And so markets always like to project into the future and try to sort of gauge what's happening down the line and act according to that rather than just what's happening right now. So gold starts outperforming during a period where essentially we're just anticipating rate cuts down the line. And so it's just hitting record highs, record highs. Now we've seen the rate cuts, but now we're in a sort of pause phase. And so, if we could sort of liken that to what's happening here, right? So we saw the rate cuts, given that's that bullish run, we saw a pause in the middle of it. And ultimately, gold pulled back. And then once we resumed the rate cuts, then it kicked on and then pushed up into record highs once again. We're in a pause phase, so consolidation isn't necessarily surprising. But interest rates in the US are not going to remain at 4.3. So we're expecting to see this drop significantly, more likely the second half of the year. So does this mean that we're going to see more consolidation? Very possible, quite frankly. I mean, ultimately, if I get rid of that and we just look in terms of the near term. So this is the chop that we've been seeing recently. It's a notable break from the pattern that we have been seeing previously. So we can see we sort of retraced into an ABC style Elliott wave retracement into your 61.8 fib. We've rallied from there. We've pulled back. We've set a higher low, higher high, now creating what looks like a higher low at a 61.8 once again. So there is a good chance that this is just going to continue that bullish theme. Very good chance. If we see a particularly heavy, sort of high inflation number, yes, that could quell the bulls for the time being, and we could just turn this into a sort of disorderly chop. But at the moment, the bulls are starting steadily getting back into play. Part of that is because of the fact that inflation has not reared its head. And so as long as inflation remains low, we can see markets sort of tentatively regaining confidence once again, and gold starts to come back into prominence. In particular, if we start to see equity markets rolling over because gold's providing a strong haven role of late. So essentially for me, I'm bullish for this market over the long term. For the near term, I know that inflation is going to be key because it opens up and unlocks rate cuts, and rate cuts historically are very good for gold and can either kick off bull markets or essentially extend bull markets when we see rate cuts, as we've seen historically. So when we do see them resume, when we do see rate cuts kick back in, which is going to be in the second half of the year, well, unlikely. I say unsurprising because we're in June already. Time flies. But essentially, if we're looking at sort of where the next rate cut is expected, so I'm just trying to do this on the fly. So we're looking at something like, tell you what, let's just do probabilities. Here we go. So the rate cuts expected for September. That's roughly 61% chance of a rate cut. So September. So yeah, maybe we consolidate until then, but maybe as markets do, they get ahead of it. And if they know that inflation is under control, then they feel confident that we will see those rate cuts, whether it's now or July or September. If we know the rate cuts are happening, then we act ahead of it. So I'm bullish for gold. I do think that silver's an interesting one as well. We talked about that recently. It's really been outperforming and reversing the sort of gold-silver ratio. But nonetheless, this is definitely looking strong. And if we do see a weak inflation data coming out on Wednesday, it provides the basis for another period of outperformance for gold. I hope that's been useful. Make sure to like, subscribe, and follow for more content like this. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.